But I think what we are talking about every day, and the headlines are certainly screaming, is the world is changing. And the infrastructure that we need today and tomorrow looks very different than it might have a decade ago. Just at a high level, people recognize we live in a digital world and data consumption is growing exponentially.
Hey, everybody. Welcome back to another episode of Wealth Unfiltered. I'm Samantha Parrinello, your host, and today I have Phil Shankweiler on the show. He is the managing director and head of RIA sales for Partners Group. Partners Group is a uniquely integrated investment platform who focuses on the private markets. So let's welcome to the show, Phil. All right, everybody, I'd like to welcome to the show, Phil. Hi, thank you so much for being here and taking the time to be with us.
Samantha, thanks for having us. It's a pleasure to be here.
So I'm going to jump right in with some questions for you. Our audience typically hears a lot about multifamily. It's what we do. This series is dedicated to RIAs and alternative investments of all kind. So what I really want to start with, is a little bit of background on you and the Partners Group so they can understand who we're talking to.
Yeah, absolutely. So I've been working in this U.S. wealth industry for 20 years, and primarily that work has been about providing individual investors and the advisors that serve them with investment solutions, helping them to achieve their outcomes from a financial planning perspective in partnership with great asset managers and great investment solutions. So I've represented many of the world's largest asset managers in both traditional stocks and bonds and context for today's conversation, alternative investment, private market investments. And today I'm sitting in New York at Partners Group's New York office. Partners Group is one of the world's largest diversified private markets investment firms. We today manage 185 billion of client assets across private equity and private infrastructure and real estate and credit, and actually a really new, interesting asset class, royalties. So we are providing solutions and providing access to investors to investment opportunities that might not be available to them in kind of the traditional mutual fund, ETF, stocks, and bonds domain.
Fantastic. So I know I did a little research with you. So I know that previously you'd worked for Hartford Funds, you've worked for Starwood Capital, and now you're with Partners Group. So you've had longevity within the business. So my first question I wanted to ask you is, how have you seen a meaningful shift in the mindset of RIAs and how they allocate to alternatives?
Yeah, well, and 20 years ago, I think the RIA industry was very different than it is today. Certainly, the channel has grown. Many of these firms have scaled, whether that has been aggregation and consolidation and M&A. They are scaling investment programs to a lot of clients with a lot of different needs and constraints, and that is certainly important backdrop for this kind of evolution of private market investing in U.S. wealth. I think what I have observed over the last 10 years is that it has moved from more of a satellite position or investment opportunity in a portfolio for a segment of clients and something that has truly become core building blocks, you know, tools in the toolkit to build portfolios for a much broader set of clients. And that's two ways, right? Certainly, the private market industry has provided more access through better structures and vehicles to allow for clients to build with those tools. But it's also advisors have just become more educated and have sought these assets out, right? So the allocations have grown, but I think importantly, they're just viewed differently as key components to a diversified portfolio.
Why do you think, was there a specific shift or a specific, macro level like phenomenon that really engaged that thinking? Or do you think it's just a natural evolution?
Well, I think that advisors have always recognized kind of from the portfolio objectives perspective, the opportunity for different risk and return profiles and the diversification that certainly comes from these assets. But I do think it has been the evolution of the product structures, in particular these evergreen funds, which have solved so many of the challenges that were traditionally there for advisors to implement. So you think about the traditional route to a private equity or private infrastructure or private real estate portfolio. It was likely a private partnership that involved subdocs, and it involved drawdown schedules, and tough to manage on behalf of a lot of households that you're managing. And these structures have really solved for many of those issues. These structures allow the investor to get a dollar immediately in the ground and invested, and not waiting for that traditional structure where you're drawing down capital over time. They've obviously allowed for more diversified portfolios, which I think has always been at top of mind for the advisor that says, "Oh, this is a interesting little satellite opportunity to invest in this particular deal," but that's a pretty concentrated portfolio of a few investments over a select kind of investment period, right? So I do think that the structures, when we talk about the democratization of alternatives and there's just more access and more to do here, I think the evergreen structure in particular has really advanced the industry and really been the linchpin to providing these tools to investors over time.
Absolutely. And one of the things that you see, I would say the term probably most used when you talk about portfolio allocation is the 60/40 rule. But I think speaking broadly, everyone I've spoken to over the last even 18 months, even longer, when we talk about that with RIAs and the true fundamentals of what has shifted and transpired like you're talking about, I don't believe that that's really in place any longer, and I wanna know your perspective on the 60/40 or what you're seeing for the new ratio that, is pretty competitive.
Yeah, I think you're absolutely right. I do think the 60/40 has been altered. It is now not something that's aspirational. I think for many it is in place that the 60/40 or the portfolio allocation looks very different. And I think the way I view that is portfolio allocation has always been about the objectives of the portfolio and these constraints at the investor level from the objectives perspective. Or an outcome perspective, we're all solving for the same thing as allocators, right? We want growth in our portfolios. We need returns. We may need income. We're solving for risk and, risk adjusted returns, right? So we're trying to, package a diversified solution that is maybe combining uncorrelated assets. So risk, return, and correlation, kind of the stock variables of modern portfolio theory, right? And then on the other side, you have liabilities. Clients need their funds at some point and they will retire, and there's life events and there's taxes and all of these things to consider at the portfolio level. And if you think about the inclusion of private assets to this 60/40, there's just now more tools to achieve those outcomes and potentially do that more efficiently. So we may be able to get to a better portfolio outcome if we are including assets with a different risk and return profile that obviously are uncorrelated to the other risk assets that we have in the portfolio. And there may be some unique opportunities, certainly in real estate and other areas, to take advantage of some unique tax rules that can be beneficial to the individual investor, right? So there's just now more tools in the toolkit to achieve those outcomes. Coming out of COVID was an interesting time, maybe even 7, 8 years ago, when we were kind of in this zero interest rate environment. And as we moved through that time, the 60/40 was a tough allocation when the 40 was really about income and low volatility and diversification. But without that income or that yield component, it was tough to get to the outcomes. This kind of first wave of advisors and investors, particularly looking at real estate, right? In 21 and 22, when interest rates were zero and you had some interesting yields on kind of core high quality real estate portfolios, coupled with a really attractive fundamental backdrop. Folks were moving out of cities, and the multi domain that you speak about all the time was certainly underpinned with some strength, and the e-commerce phenomenon was behind the world. We're building new industrial complexes. So you had this new asset class that could better achieve the goal, right, of income and low volatility and diversification. And there's some tax benefits, and we saw advisors, begin to really lean into that, right? So I think that outcome-based view, and you think about the 60/40 with more tools to achieve the goals is really what's driving that, and it's now very clear. I think where it was a story and an aspiration and something, that was to be included, now it is absolutely a part of the portfolio allocation.
Absolutely. One thing that we've been seeing, I think that you see a lot of the writing on the wall when you see these large institutions really leading the charge. And I think we've seen a lot of that. But can you speak more to, Partners Group obviously gives access to individual investors and RAs and clients of all shapes and sizes. Are you seeing that same trend over all of the different investor types?
Yes, just in terms of the broad allocation increasing. Yeah, absolutely. Might be news, but institutions have long been the capital behind the private markets. And for 20, 30 years, 90s and 20s, we saw institutions begin to really advance those allocations. There was the famous professor from Yale and the Swenson model, and these things became real for the institutional audience, pensions, endowments, foundations, and family offices, such that the allocations grew, fairly quickly over a short period of time. And over the last decade or so, those institutional allocations have largely at least slowed the growth relative to a U.S. wealth market and an individual investor and a financial advisor that is just now looking to expand the allocation. So while private markets broadly have grown and the allocations across all segments have absolutely grown, the more significant growth that we've certainly seen, but I think the industry has observed, has come from the ability for the individual investor to build that exposure and to get access to these asset classes.
Absolutely. When you speak about private markets, I was reading about on your website, trying to understand a little bit more about what Partners Group does. It speaks a lot about infrastructure and investment. And so what I wanted to find out first for our listeners, for people who are unfamiliar, if you can kind of give a one-liner on what that investment looks like, how it's structured, but more specifically how now either it's evolved or where you guys see it going.
Yeah, absolutely. And I always just start with, what is infrastructure, right? I think people confuse the topic, but it really is so clear to see in our daily lives, right? These are the assets and the systems that support the critical needs of our world. And I think most folks can kind of picture that in their life today, right? The cell phone in their pocket, the transportation to get into work today, the lights need to be on, electricity is a part of everything we do, right? These are, and I would just describe them from the portfolio allocator's perspective as really unique assets from the fundamental perspective, right? And there's really three things that have underpinned why they are so unique to other things. These are generally assets that are less sensitive to the economy. And the idea being, okay, we go through a really tough time economically and unemployment increases. We are still going to continue to need those critical assets and services. We will turn the lights on. We will go to work. We will use our cell phones. The second piece of this is these are generally assets where the returns are predicated by long dated contracts, right? So if you're building the new power generator or the power generation facility, you are likely not going to spend all that front end investment without an idea of the offtake, as they say, the utility taking that power from some significant period of time to come, right? And that is the underlying cash flow that ultimately gets to the return or the income stream for the investor. And the third is that, again, these are generally backed by assets. So, from the investment perspective, should there be a downside scenario, there are generally physical assets or tangible assets that really underpin the investment from the downside protection perspective, right? But I think what we are talking about every day, and the headlines are certainly screaming, is the world is changing. And the infrastructure that we need today and tomorrow looks very different than it might have a decade ago. Just at a high level, people recognize we live in a digital world and data consumption is growing exponentially, right? And I think we can all recognize, or maybe this is interesting to some, but in the United States, energy demand was essentially flat for decades. Today, we are growing energy base load. So just the underpinned electricity that moves through our world, we're growing at a 5 to 6% CAGR year after year. It might not seem like a big kind of growth rate from the investor perspective, but when you think about the massive capital investment underneath our world and what that looks like to not only provide new supply of those assets, but as the world changes, we want cleaner energy. We need more reliable energy. We're thinking about grid reliability. We're thinking about, the ability to distribute energy where it needs to be and when, and to do that in a kind of uninterrupted way. So the needs are so great, or as I'd say, the structural demand for these assets is, as some say, the investment opportunity of our lifetime, right? There's so many kind of industry titans out there talking about, what this asset class is, but it generally is a asset class, as others are based on supply and demand. And we have this long-term structural demand for these assets, or as we say, the next generation of infrastructure. And we just don't have the assets in place to provide those needs, nor the capital. So the opportunity for the private investor to step in and to help the world build and develop these assets is really what underpins the investment opportunity. And what we think just makes it so exciting from the portfolio allocation perspective.
So when you're talking to, let's make it a very specific avatar, sorry, marketing language,
Sure,
but if
absolutely.
let's say that you're looking directly speaking to an investment advisor and they're looking at you and they're saying, okay, I'm very interested. I think that this makes sense for our portfolio. I want to learn how to allocate more of this. But if they're going to speak to somebody and they're going to try to really explain not the macro level of what you've just gone over, but the fundamentals of why this makes sense for their portfolio. What would be maybe the top 3 reasons why this would make sense to incorporate?
Yeah, I'd say just first going back to the portfolio objectives, there's a really interesting investment return opportunity here for investors that again are helping to build and provide those assets, right? And you can provide an example today. We certainly are kind of leaning heavily on the energy theme. So again, today, big demand for new energy power generation, or to even just solve simple problems. Like, people talk about data centers, right? But the data center needs energy that you generally just can't turn on tomorrow. We invest in a company, for example, called Life Cycle Power, that is ultimately coming onto site and providing energy from 18-wheeler nat gas turbines to literally bridge the energy gap, with a data center theme and a data center investment sitting on top, right, that just needs that energy today. There's a great return for the investor that can help that business expand and build more of that capacity, right? But it is an investment that is protected, or at least comes with many of these defensive attributes of, these are critical assets, these are contracts, these are backed by assets, right? So I think the return and risk, just from the highest level, there's an amazing kind of an opportunity that exists in the world. These are assets that come with some pretty interesting kind of downside protections. Are the way to present that to a client today. I often think 20 years ago, advisors were speaking to advisors or clients about, consumer staples and utilities in the public markets, right? And these were the places to get good kind of defensive equity-like returns, but maybe something that isn't so kind of high risk or high beta as, the tech sector or the more exciting healthcare ideas, right? So I think that's the general frame. Really interesting investment opportunity from a return perspective, and really kind of compelling tool in the toolkit from a defensive perspective.
Well, being somebody who doesn't know a ton about this, is there are a lot of tax mitigation strategies. Does infrastructure offer any of those type of benefits?
It certainly can. So depending on the strategy, but these are asset heavy or equipment heavy platforms or companies in many cases, right? So there's certainly the kind of the same lever from a depreciation expense against, earnings of a particular platform or investment, right? So there are some of those levers as well as you see in real estate. So yes, I think the short answer is this is relative to some other companies that might not have the ability to offset some of the earnings. It is a pretty interesting tax efficient asset class given the strategy. Yeah.
I know that's a big focus for, a lot of our listeners. As much as they want the upside, they really want that tax mitigation. So that's an
Yep.
important piece. Earlier you mentioned Evergreen. And one of the questions I wanted to ask you is, why do you think that evergreen vehicles are becoming such an important part of the RIA access and high net worth individuals?
First, on the portfolio perspective, like, again, one of the promise of Evergreen is getting your dollar invested on day one, compounding the return from that investment into perpetuity, as opposed to I invest in a private capital pool, I wait for that fund manager GP to invest, find the investments, draw down on my capital, invest over time, and then they'll sell the investments in 6, 7, 8 years, and I'll get the capital back, and I'll need to think about the next project and the next project. The promise of Evergreen is to have that dollar fully invested on day one, and to, as the manager, efficiently, continuously deploy that capital into the next investment and the next investment and the next investment, so that the investor can compound without needing to write another project or another GP or another fund, right? So that is the first. The second is the portfolio allocation, again, just looks very, very different. These are generally very diversified strategies, as opposed to something that might be more concentrated in some of those more traditional kind of private asset structures, which I think from the allocator's perspective, again, is just kind of key to inclusion as a building block or a core component of a kind of a strategic asset allocation. And the third, the structures themselves are more, I think, efficient, but also a bit easier to use for the advisor and the investor. We generally are structuring evergreen strategies as an industry with lower minimums. These are generally things that report on 1099 tax reporting as opposed to getting a partnership K1. So there's a host of kind of solutions in there to the traditional problems that has advanced Evergreen to where it is today. It's just been a better mousetrap for many advisors and many investors to get exposure to these investments.
So that brings me to two questions. I'll start with the first one. I just had mentioned risk, but how do you even evaluate risk when there could be a potential for so many different investments, over the evergreen period?
Yeah, I would liken it to how an advisor or investor might look at a diversified mutual fund or ETF, right? At the fund level, you can get an understanding for the types of investments, the exposure of the investments at the actual platform, or what we would say is, that particular investment manager's strategy. You can get a really good sense for, as they call it, how are these being underwritten? What are the risks that we are controlling for? How are these investments ultimately coming together? So I think it's twofold. I think you are looking at the overall fund level and the allocation and kind of the look through of all of the different investments that are in the Evergreen Fund, but then having a really good understanding for what does this investment manager do? What are the types of investments they do? How do they find unique deals? What does that actually look like from a risk perspective?
I think the idea of evergreen could scare people to think, okay, what about my investment as far as liquidity? Are there hurdles? Are there things that happen, or how can you speak to that hurdle when it comes to an RIA advisor trying to explain that to somebody?
Yeah, great question. I think as an industry, well, I'd hope we haven't done this disservice, but sometimes I do think evergreen is used synonymously with liquidity, right? Or this is a semi-liquid structure, and I just don't think that's the right way to think about it. I always say to the advisor and the client, you are buying an illiquid asset, right? It's just as if you bought that industrial commercial property down the street in America that takes 4 to 6 months to get to market, hire a broker, go through inspections, and get to a closing table, right? So these are not liquid assets, and nor should the funds or the shares of the funds be thought as liquid investments either, right? So they certainly have these added attributes of maybe more options or more optionality as to when you can get your capital back or plan on getting your capital back, as opposed to waiting for the drawdown fund to sell a property and distribute cash back to investors. So I think of them as these are illiquid assets. These are generally to be thought of as illiquid shares with more optionality over the entire time horizon of your investor's portfolio, right? But I always just go in with kind of that risk first perspective to say there will be cycles, there will be times where it will be really unattractive to go and sell into this market. And that's exactly the last time we should think about kind of rotating or trading in and out of these asset classes. I think it's so interesting on the traditional side. For many years in my career, you think about kind of the big lessons of Jack Bogle and Vanguard, which was, we know that individual investors trade maybe too frequently, right? And they ultimately don't have this long-term perspective on certain, positions or investments that they make. And I think that's just such an important kind of starting principle, right? That we are building these portfolio allocations to invest over the long term. There will be cycles, and that's generally the last time you should think about trying to sell an asset at what could be, a trough in that particular asset class's pricing, right? So yes, I think the perspective and the way the advisor and the way the individual investor ultimately comes to think of what this structure is so, so important and will ultimately provide a much better investor experience for those that take up the evergreen promise and the structure into their portfolio.
When you kind of just touched on it, but to me, is there a best practices for how to advise people or a way you like to frame it as far as time horizon for these and when to understand even are there going to be moments where you actually cannot take your money out? Is there anything like that for when they want to discuss this element?
Yeah, I mean, I again, I always kind of start with like the underlying asset and our investment strategy. If we were to talk to a private equity investor, we would say these are generally 6 to 8 year time horizons. You should kind of think about that type of time horizon for the overall investment, whether that be you're buying the individual or you're making a direct investment or you're buying the fund, right? So I think the long term time horizon is the starting point. But then to your point, the father-in-law test at my, Sunday dinner, right, is generally starting with the worst case scenario in some cases, right? Is to say, listen, in over 10 years or that 8 year period, there's going to be a cycle. And there's going to be a period where if it's real estate or if it's infrastructure, if it's private equity or fixed income or whatever it might be, the cycle will change and there will be a period of time. That's what risk is. That's where the return comes from, right? There will be periods of time where these assets will be extremely illiquid, and that is exactly the time we shouldn't expect to get our capital back. And we as investors need to be prepared to weather through that cycle and to hold on to assets through the ultimate duration of either the asset profile or the investment strategy, right? So, yeah, I think about kind of the time horizon broadly as the underlying time horizon of the investment that you're going to make, and then I think you just absolutely need to get the perspective of cycles and down periods and what that liquidity will look like, and have a real kind of clear-eyed view of is this right for me and is this right for my portfolio? And for some, that just might not be right? It might not be a fit, and, I think as an industry too, we should always be so cognizant of that, not all portfolios, not all investors will want to take those types of risks, right? So, always gets back to, great, financial advice and having professionals that can help you understand that, but as an industry on our side too, I think we start every conversation from, exactly what this is and how that will work over time so that folks really understand it.
Absolutely. You were talking a little bit about the historical context and the cycles and the ebb and flow, but where you sit today and you look ahead, where do you see the next 5 to 10 years of private markets evolving?
I think from a portfolio perspective, again, or maybe individual investor perspective, the allocations will increase. And as the allocations increase, I do think that there will be more asset classes or more investment opportunities, right? So folks might have had their first experience with alternatives or private markets. It could be real estate, or it could have been credit or private credit. It could have been private equity. And now things like infrastructure and different segments of direct lending and different ways you can invest within the real estate market, right, are opening up these kind of frontiers for the next asset to be included into this diversified portfolio, right? So I think the allocations grow. I also think they become a bit more thoughtful, a bit more diversified, maybe a bit more precise in what they're trying to achieve and the diversification, risk and return profile relative to other things in the asset class. Now, from the industry perspective, there will be more solutions. There will certainly be more access. The world is talking so much about defined contribution plans and access to different types of private market investments. I think it's clear that in 3, 5, 7, 10 years, the allocations within these retirement programs, DC plans, will be higher than it is today, right? And then on the operational piece, I think this gets back to kind of evergreen and structure. I do think operationally it'll continue to get easier to get access from maybe our perspective. There's so much that goes on to kind of the back end operations of this business. And things like blockchain and distributed ledger are talked about inside the halls of, all of the asset managers in the world today, to think about how can we better serve our clients? How can we better transfer assets more efficiently and more cost efficiently, right? So I think, yes, I think, the investor has more solutions, more access, and ultimately can build a broader, maybe more diversified portfolio using alternatives. I think, the access into other areas like retirement plans is certainly growing, and operationally, I think we'll see big, big changes over the next coming years.
Do you think that alternatives will become part of the portfolio architecture in a much bigger way rather than being like an alternative allocation? Like it'll be a fundamental more than it is now?
Yeah, I think there's many that say maybe the term alternatives isn't the right one. And the starting point for many is just the total size of these markets within the total universe, the total capital market universe, right? And the industry touts these statistics every day, but on the private equity side, today in the United States, 90% of companies earning 100 million more in revenue are private companies. And you compare that to a decade or 2 decades ago, that's a monumental shift. That's been flipped upside down, right? So if companies are seeking financing, private companies are seeking financing, whether not choosing to go public at the same point in the life cycle, or even not choosing to go public at all, because the private markets have evolved in a way where capital is now available to them to grow their business. That creates a very different equity universe, right? And the same on private credit. It took 5 years for direct lending to, supersede bank loans, and now high yield, right? This asset class is just as big, so from the kind of total universe and diversified portfolio perspective, are they truly alternatives if they are such major components of the total asset universe? I think that's becoming more and more of a debate, right, over the coming years. But I think you're exactly right. It's certainly not this kind of slice off to the side or this satellite that it was, or alternative in that it's different. It is equity, it is credit, it is real estate. It is just owned in a different way and structured in a different way. And that has advantages and benefits and disadvantages and trade-offs, right? So as we think about equity risk and credit risk and real estate and what that is, it's all in the same, right? These are the same risks.
Do you think there's one or a few areas of private equity, or excuse me, private markets that are just really misunderstood and that may become to light or really, really evolve for the better over the next coming years?
Yeah, I mean, maybe one on just kind of like the private equity side. I think private equity has, there's a lot of misnomers and a lot of maybe views on it from the outside. One is just, I think there's this constant comparison in the advisor community to compare, public equity and private equity from a fees perspective and returns perspective, and everything's kind of apples to apples. And much of the model in private equity or in this growth equity domain or even venture, is about hiring or working with a general partner that has the expertise and the network and the scale and the playbook to take an active role in building that business, and to ultimately getting that business to another level of scale and another level of profitability. So the model is different. It isn't, and the costs are different, right? So operating that model, working with a partner to actually come alongside or inside that business to help it grow and expand. You look at the kind of inside the walls of a private equity firm or a public equity firm, the costs and the resources are just totally different, right? So I think that's one, and that ultimately means that the return streams are different, right? And I think one of, yes, the opportunity in private equity in terms of private companies making up, a large swath of the universe is absolutely true. But the other is that those return streams, the ability to kind of find the small company that is growing into some other market or expanding and doing so with this very strategic plan to create new value and grow is just a very different kind of risk and return proposition, right? Than just kind of diversifying into a new segment of equity. That's certainly one. And, I think the structures are just broadly misunderstood to some extent, right? I think the structures are designed to protect investors and protect long-term investors. And again, I do think that when we say the word fund and we say evergreen fund to the universe that has kind of been conditioned over time with liquid structures, mutual funds and ETFs, and just trading stocks and bonds, it gets categorized in the same way that these things should be liquid because they're funds, right? And the assets are not. It's a very different universe. So I'd say those two things. I think the operating model and what they're trying to achieve from like a public to private kind of operational construct, and then obviously the structures themselves and the liquidity of what you own is just completely different and maybe misunderstood.
I agree. And thinking about from the RIA perspective, let's say they've listened and they're like, yeah, I think that I really do need to start educating my team, right? Like an actual RIA, maybe a smaller mid-size who wants to really start learning and allocating to private markets a little bit more, alternatives a little bit more. Does Partners Group, or do you have any suggestions on resources where they can start doing that? Because what I could tell you is we were just at the Fact Right conference where we spoke with tons of RIAs. The overarching theme was that they don't have a lot of resources. So they don't know a lot of times where to go or how to really start learning about these alternatives in a way where they can actually build confidence to actually talk about them.
Yeah, absolutely. One from an industry perspective, we work a lot with organization, Chartered Alternative Investment Association, and they are obviously kind of the one of the preeminent kind of sources of maybe some of the more academic, content or educational content, but they have created an entire program designed for wealth and advisors, the RA market, more consumable education and I think nomenclature and that's also maybe more relevant for the conversations that we're having with individual investors. So I always will plug Kaya. We work with them. We help support what they're doing on that front. And yes, from a Partners Group perspective, we've invested heavily here. I think this is, we didn't talk about it much, but it might be nothing, right? Is that there is just this education gap, whether that's how the assets work, how these investment firms work, how these structures work, how do I get access, how do I build portfolios? It's so different than our kind of traditional world, again, of stocks and bonds where, there was always kind of a new frontier to learn and a new asset class and a new idea. In this domain, everything can be new to the investor and the advisor. We've built an educational hub called The Campus off of the Partners Group website that is just designed for advisors and the wealth community and ultimately individual investors. So there's primers to share with the individual investor about what is infrastructure and why is this an interesting part of the portfolio. But then there's also some more kind of 201 resources for advisors, such as what makes a good evergreen. One thing about Partners Group, we are the largest private equity evergreen manager in the world. And 20 years of experience has taught us a lot about how to manage, how to think about risk, how these structures work through cycles, how to manage liquidity on behalf of a lot of different investors with different needs and liquidity needs, right? So we had put together a 5-part series about what makes a good evergreen portfolio. Those are the types of resources that we make available on the campus. So I'd absolutely shout out those two.
Amazing. Well, I want to ask you one last question because I do value your time and I have really, really enjoyed this conversation. But if there was one thing that excites you most about where private markets are going or infrastructure in particular, or even one investment that you have right now where you're like, if there was one thing I'd recommend, like what would it be?
Yeah, I would put my finger on infrastructure. I think when again, getting back to like the portfolio of risk and return, I just don't know if we can speak about or I can speak about a better or more compelling risk and return proposition as the world thinks about some of these big themes. For one, energy, right? It's going to be a very long, multi-decade investment theme with so many private market investors. And yes, we need new assets and build new assets, but there's just any kind of investment universe where it's this massive swath of problems to solve, like how do we actually get energy to certain projects, manufacturing facilities that are getting built faster, right? How are we going to inspect all of the new pipeline and all of the new hard assets that are now getting constructed across our world? That needs new technology and new things, right? So I think from an excitement perspective, yes, the asset class, but these particular themes that underpin it are just really exciting as you think about kind of long-term themes and long-term opportunities.
Fantastic. For those listeners who want to get involved with Partners Group or specifically reach out to you, how can they do that?
Yeah, find me, Phil Shankweiler Partners Group on LinkedIn. Certainly can even share my email here with this group, but through the website on Partners Group, it's really easy to connect with any of our relationship managers, no matter where you are around the world. So please visit us at partnersgroup.com.
Fantastic. Well, Phil, I cannot tell you how grateful I am for you to be a part of this educational series. I really hope that our listeners find as much value as I did today. And to our listeners, I want to thank you all for joining us and stay tuned for the next episode.
Thank you guys so much for having us. This was a blast.